Welcome to This Week in Money. I'm Jim Goddard. Today, Institutional Advisors market historian Bob Hoye looks at the dangerous bond bubble we face. Casey Research senior investment strategist Louis James on how to make money during falling equity markets. We'll talk to Bob Hoye right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. But before we start talking to Bob, mostly about the bond market, we have a special concert announcement. Singing impressionist André-Philippe Gagnon will be in Kelowna December 30th at the Kelowna Community Theatre and in Oliver December 29th at the Frank Venables Theatre. For more information and for tickets, go to ontourtickets.com or call 1-855-411-7500. And now back to our guest, Bob Hoye. Bob, the bond bubble. Everybody keeps talking about it. Can you maybe explain why there is this bond bubble and why we're so concerned about it?
Oh, yeah. You know, in the financial markets, the longest continuous history is of interest rates. And back in the early 70s, a bond guy with one of the big houses in New York, Sidney Homer, had a crew, and they went and checked out all of the history of interest rates, put it all together in a good book, and that's it was long ago with that when I became interested in interest rates, and they're fascinating, and it records history. But what we've recorded here since, well, let's start back it right up, Jim. The big bear market for bond prices, which went down as the yields went up to 81 actually. That's when long Government of Canada bonds got up to 19%. And the rush had started in the mid-1960s when it was about 5%. So that, in the senior currency, put interest rates up to the highest on record. And the irony is that they were trying to lower rates. You go back to at the end of the war in the 1940s, the U.S. government had taken on a lot of debt at, say, 2.5% to 3%, and then the politicians and economists could look at that and say, gee, if there's any rise in interest rates, the cost of servicing that debt will go up. So somewhere in the late 40s, the Treasury started buying bonds to try and keep interest rates from going up. And then in the mid-60s, as I said, we were at a 5% yield, and they were trying to keep them from going above 3%. So then in the mid-60s, they got really excited about this, and because that was when the dance craze, the twist had started, they called their Operation Twist, where they were really going to dramatically buy bonds, and that would keep interest rates from rising. And then they were really put it on when it got to 6%. So eventually, of course, it didn't work. We're on a cyclical rise in interest rates, and the U.S. Treasury got up to 15% in 1981 as commodities peaked. And then you had 1982 the change, which was that the public shifted from hitherto speculating in commodities and producer prices and CPI inflation, got hit very hard in the commodity crash, and then the market over a number of months in 82 shifted over to suddenly buying the stock market and the bond market. So then you ended up to where we are now, or recently. You have this long bull market for bond prices, and going the other way, the long decline in interest rates. And you've had some swings in the middle, of course, because starting in 1981, now that was a long time ago, you've had the business cycle in there, so that on each business cycle, you'd have rates, treasury rates going up, Then on the recession, Treasury rates going down, and right on through. I can't count how many recession cycles there's been since '81, but there's been quite a few. So then this then reached its best, and you have to look at different categories of yield instruments, with the junk, lower grade stuff, parting right up until June of 2014, June a year ago. And that was a very good momentum in that. Lots of technical stuff on the price advance, and I just had looked it up a little while ago, and when our published stuff, we wrote that, and that we were pounding the table on how strong the technical signals were on the lower grade market to get out of all junk and stuff like that. So it was down to about a 5.5% yield, and recently that yield got up to about 8.5%. So it was certainly the right move, was to get out of all of the lower grade stuff, and but there's been some trades in it in between. Now the other part of this was when, here's where it into play, Jim. This is interesting stuff, because in 2014 you had the last high for crude oil, around $107 around June, and our technical work on that one got that reversal, and we were then looking for crude oil to fall to either 37 or 27, or maybe somewhere in between. Well, it's already declined to 37. So, but we want to go back to this time last year and into January, when the crude oil was really crashing. The favorite play then was to roll into long treasuries or long Government of Canada bonds, and the rally was absolutely outstanding. And it reached a peak at the end of January, early February. And now, also with that, over in Europe, you had the most extraordinary decline in 10-year yields in history. I mean, it never happened before, under some very reckless policy by the European Central Bank. German yields got down to 0.06%. I mean, it was absolutely absurd. So anyways, we worked on the technicals on the long treasury, because it really is the main market in the world, and it was giving us upside exhaustion readings, lots of momentum, all that sort of stuff. And we noted that, and I wrote a piece called Ending Action, which was calling for the end of the bull market in treasury bonds, and which meant that interest rates would then head up, which has indeed been the case. A couple of rallies since have been to lower highs. But also in that piece we wrote at the end of January, last January, was that should the U.S. market reverse, it would probably reverse the action in Europe as well. And yes, there was a tremendous change in their market, but everything's been static there for quite a while now, with interest rates exceptionally low. So if we go back to the article in January called Ending Action, that was talking about ending the big bull market in bonds, or going the other way, the amazing decline in interest rates that began in 1981. And this is a very profound thing, as it seems to be turning. So one would question about what would cause interest rates to go up. Now, the standard notion is that if you look back in the 70s, which then increased interest rates to unprecedented levels, of course it was the speculation in commodities. So now if we're looking for another rise in interest rates, would it be based upon a new big bull market for commodities? And not likely, because there's a thing that can happen, and we call it a post-bubble contraction, which you had following the huge bubble in 1929, the previous bubble before that, which concluded in 1873. And in those bubbles, the decline in basic prices becomes a problem, because it shows that most businesses and industries really don't have any pricing power when you have weak commodities. And without pricing power, their profit margins are not so good. And without profit margins, they're not making so much money, which means that they can't cover the debt taken on in the party time. So then debt becomes unserviceable, and then along comes the credit rating agencies that mark down the ratings, and so you can get some of the worst increases in interest rate in a post-bubble contraction. And that then gets into all sorts of issues with just too much debt and not enough economy to such that businesses can service the debt. By servicing the debt, of course, we mean paying the interest and also being able to retire the bonds at maturity date. You have enough money in the kitty to pay for that. So that's on the corporate side. And then what you have is a problem on the government side, whether you're a federal government or a state or provincial or even a municipal. You have that problem. So what happens on the recessions in a post-bubble contraction is that the ability of governments to tax becomes very difficult, because if companies are not making so much money, how can you tax them? So then tax revenues come down, and then that impairs the ability of state and local governments to service their debt. So it all becomes a horror show.
We'll have more with Bob Hoye next on This Week in Money.
Always consult your investment professional before making any investment decision.
You're listening to This Week in Money. I'm Jim Goddard. We're chatting with market historian Bob Hoye.
Actually, when I was doing all this historical research decades ago, you could look at the financial publications, either the daily ones or the weekly ones like Barron's back in the 1930s. At the end of that 1929 to 1932 bear market was a horror show, and it took a number of weeks before the market stabilized in July of 1932. But there were no news announcements that by government or policy measures that ended the bear market. And if you looked at these publications week by week, the only thing that changed at the time was that the selling of bonds stopped. The supply ran out, and then it turned around, and then, of course, the rally that came out of July 1932 was very, very strong. So this is where we're going to look now, is that interest rates generally can rise over the next couple of years based upon financial stringencies, weak commodity prices, and things like that. So it's the deflationary side that makes it very hard to service debt. And this then does things to interest rates that, unless you've been there or read the history, you can't imagine it. And I know that central bankers have never read any financial history, so they can't imagine what goes on. And this is what we call real interest rates. Now, one of the issues recently has been that the theories that the central bankers haven't been working. Their theory is that if the central bank provides easy credit, that will immediately create business activity. And we're seeing that this is not the case. The easy credit is going into, well, until recently, stock and bond speculation, and not into the real side of the economy, like commodities and stuff like that. So these policymakers are becoming more desperate, and they have talked about putting negative interest rates on. So if you put $1,000 into this whatever yield instrument, you'll get somewhat less when it retires, maybe 1 month or 2 months or 3 months later. So that would be a negative interest rates, and they're thinking that, and actually I can't remember at the moment, but there are a couple of countries, a couple of central banks that are actually pushing this. I think Sweden. And it shows an incredible desperation on the part of the policymakers, and it won't change anything anyways. So, but these are slightly negative nominal rates of interest. It's what you get at the end of the month. kind of thing. But there is another way of looking at interest rates, and that's where you take the rate of interest, say it's 3%, and the rate of inflation and say that it's 4%. So then you're actually getting a real interest rate of -1. So there is a long history on that one, because you, as I say, you've got a very continuous record of interest rates, certainly continuous going back to 1700. And the pattern has been is that on a great financial mania, the first one was the South Sea bubble that completed in 1720. And so what you take then is what the inflation rate was in the CPI and what the rate of interest was then, annual basis. And then you had other bubbles. There was 1772 and then 1825, and then, as I say, all the way out to 1929, and also to 2007, because that was a classic bubble. And the pattern is consistent. Is during a great financial mania, real long interest rates in the senior economy, formerly England, now United States, declined significantly. And the decline, it kind of depends on where you started, but a couple of the bubbles, the decline was down to -6% on real because of the party with the boom, and so prices of things were going up, but interest rates were going down because people were reaching for yield. But the other thing that's consistent about that is it doesn't matter whether you ended up with a +1 rate of interest real at the bottom or at the top of the market, or -5, the typical increase was something like around 12 percentage points. And that's a huge increase in the real cost of money. And what it seems to be is that Mother Nature is putting a huge cost on money that ends the abuse of the credit markets, otherwise known as a bubble or a new financial era. And this is going to hit all borrowers, whether they're governments or corporations or individuals. And it's so regular, it's a wonder it isn't in the textbooks, but it isn't. So we looked at this and brought it up to date the other day, and in the 2007 bubble, the long U.S. Treasury real rate got down to -1.5%. And then in the hit in 2008, in that horrible crash, it got up to 6% real. So that was an increase of, let's just say, 7% to do round numbers, and 7 percentage points. So, and that was very hard deflation, huge drops in security prices, and it was a nasty crash. But as I said, the typical increase is 12 percentage points. So that one didn't go as severe as it might have. And then on this latest boom, which we take as the first business expansion out of a classic crash, along with the first bull market, this now is becoming tired. The interest rates and credit spreads and yield curves are already changing. Probably the U.S. is in a recession already. Retail side in the last 5 or 6 weeks, the stocks have fallen very hard. So let's assume a recession here, and you can see it happening as it happens, that the ability to service debt will be impaired, interest rates will go up, and they might go up faster than the rate of inflation. So what you had with this latest boom is that the real long rates went down to about 1%, plus 1%, and now they're up to 3%. Hey, no big deal, but if it breaks out and the real rates go up, you can at least, and we've in our own recent times have had a 7 percentage point increase in real rates. That's easy, that's possible, and it's also in a big historical sense possible to get the full 12 percentage points, which would be a tremendous shock to the financial system. I think it'll be so severe that many people will lose their belief in the abilities of central bankers, and it might even be very good if central bankers lost their audacity to think that they can manage an economy.
Are we going to see bonds default? Is there danger of that?
Oh yeah, that's that's the other part, is with weakening, weak business conditions and weak pricing abilities. As I say, it's very difficult to service debt. And there was a publication in New York done by a small bond dealer, and I think printed in 1933, and they covered a lot of the sovereign debt bonds then in England. If you were in England, we call it foreign debt, and they were just disasters all over the place with defaults and no bids, that sort of stuff. And I think the article on the amazing failures ended with, and yet nobody ever learned. That was 1933. So here we are again. This looks probable that governments, corporations, and individuals will have problems servicing their debt. And if you actually go all the way back to the 1500s, when Gresham, anybody who's been in the markets for a few years has heard of Sir Thomas Gresham and Gresham's Law. And Gresham's Law roughly is that bad money drives out good money. So if you come out with paper money, too much of it, gold goes into hoarding, and the real price goes up. But also Gresham was a private businessman who was one of the great traders in history. At that time, the main market was in Antwerp, and he was a financial agent there for the Crown, Elizabeth I. And his letters to Lord Burleigh, who was then Chancellor of the Exchequer, basically explained the way markets worked. And the other part about why commodities are chronically weak in a post-bubble condition is that the senior currency is chronically strong. And the reason for that is that in a bubble, most of the debt is written in the financial center, which was London and now New York. So just for argument's sake, let's say that on this bubble, maybe 65% of all of the debt issued may be due and payable in U.S. dollars into New York. And that is the killer, because then that represents a huge short position of dollars. So our line is that in a post-bubble contraction, the senior currency becomes chronically strong against most other currencies and most commodities for most of the time. And that then is the problem of servicing debt into the financial centers. So you have, say, countries that owe money into New York, Bolivia, or whatever. They've got to sell something in order to get a dollar, in order to have their debt, service their debt in New York. So it becomes quite a grinder. And this was also mentioned in the letters back in by Gresham in the 1550s, was to say, stop your spending to Elizabeth and get the sterling firmed up. And then the cost of servicing debt in the financial center is not as difficult then. So here you are. The U.S. dollar has been firming. It's probably going to take a little rest here for a while, maybe a few weeks, maybe a month or so. But the main trend is up. It's very confusing to the central banker, especially the Federal Reserve, who want to depreciate it, because they think, good things come from depreciation.
Bob, thanks a lot for chatting with us.
Jim, very good, and we look forward to talking to you again.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. Coming up, KC Research senior investment strategist Louis James on This Week in Money.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Louis James, Senior Investment Strategist at KC Research. Welcome to the show, Louis.
Glad to be here.
We know the markets are not in the best of shape right now, and a lot of people are predicting 2016 will be really the showdown date for the equity markets. How can you go and make money in a situation like this when everybody is expecting most commodities to go down in price?
Well, that's actually an interesting question. Of course, in general, one can make money on markets whether they're going up and down just by predicting the right direction. You can short. That's not our business model, so we're looking for volatile stocks that are oversold and likely to rebound. And even stocks that are trading in a channel, you can play the channel and make money. That's not an easy thing to do unless you're paying close attention, but there are lots of ways to make money, whether a market is going up and down. And even gold bugs that we are, we've made some money along the way here by recommending puts on GLD when we thought that the rebound was too much and gold was likely to go down. So we may be gold bugs, but we try not to be too religious about it. We try to look at which way things are actually likely to go next and bet accordingly.
When you're taking a look at the general direction of a market, do you try to encourage investment still, or a company that's trying to start up or maintain its business, how do they get along in a market where people are shorting them?
Well, that's two different questions. One is, what do we advise as investors? And then another would be, what would we do with companies? And for the companies, well, it's very tough. But that's obviously also an opportunity. So I'm not really sure how many of our listeners are people who might be thinking about starting companies, but honestly, this is a fantastic time in the sense of this being absolutely a buyer's market. But you obviously need connections, you need the right people, you need the funds, the backing to go out there and go shopping. There are distressed assets, if you will, out there that have a lot of potential. And so, with the right hands, capable, competent hands with enough financial backing to see the market through, even for the companies, this can be a great time if you want to look at it that way. And of course, for the investors, buy low, sell high. It's never fun when it's the buy low part, but that is the stage that's absolutely necessary for the sell high part later. So, we all have to be big boys and girls here. We all have to understand that markets go up and down. And we have to, deal with the down part as best we can and seize the opportunities when they're there.
Taking a look at gold, is that a good opportunity? And I'm looking at either bullion or the miners.
Yes and yes. And I'm not saying that I know exactly where the bottom will be. It might be ahead of us still. It looks pretty good odds that it might be behind us. Every time gold seems like it's going to threaten its previous lows, it just doesn't quite seem to take it out all year long. We've had all these fluctuations. I'm reminded of that epic scene in the movie V for Vendetta when the bad guy has his hands around the hero's throat and he's saying, "Why won't you die?" And he doesn't die because he says ideas are bulletproof, and behind his mask is an idea that won't die. And I think that's quite true for gold as well. Gold is money in much of the world. Most people still know that, regardless of what the paper traders in New York may think. And it's quite interesting that every time we reach a technical level, or there's some big warning flag, or the Fed scares everybody, all the naysayers are saying, "Oh, gold's going to die. That's it. We're done." And it doesn't. It continues dragging along the bottom. That tells me that there is real appetite around these levels. And when it drops lower, the buying steps in. So I don't know exactly where the bottom is, but I think this is around the bottom, and that makes it a good time to start accumulating. And of course, the stocks give you leverage to gold itself.
With the gold miners, they've had a tough time. Have they kind of gotten rid of all the so-called weak sisters, and there's good investments out there that are pretty easy to find?
Well, there certainly are investments that are easy to find. If you simply look for who's still making money, that shortens the list quite considerably. And if a company can make money now, it should make much more money when the markets cycle back up again. The one caveat to that, I would say, is you need to look at what has been cut, because you can cut your all-in sustaining costs to bring your costs down. But remember, that includes sustaining costs, which means your capital investment and your further growth in the project. So if you cut off your future growth to ensure profit now, it's sort of a fancy way of saying high grading the mine. That could not be a good buy, even if they are making money now. So you still want to do your due diligence. But it's quite simple to look at the producers and see, well, who's making money and who's not. And for the more adventurous out there, the producers that are making money now, they should be great bets when the market cycles up again. But the explorers, they are so out of favor that they're so deeply on sale that if you've got explorers that are working on projects that look economic at current prices, those guys should have truly explosive potential when the market cycles back up again. If you're the sort of person who's risk averse, maybe the producers that are on sale are the way to focus. But if you want 10-baggers, if you're hunting for big game and you want big wins, I think you need to screw up your courage and have a look at the quality explorers out there, because there are some that have great projects, and they're on the deep discount rack with the guys that got nothing.
What about silver? I thought there'd be a big demand for silver because solar is becoming so popular.
Yeah, actually, we have, across all of our resource publications, we have been switching over, not switching, I don't want to say switching, because we're not out of gold. We're certainly not negative on gold's outlook at all. But we see extra upside in silver for the reason you've just given and others. It's kind of a little bit of a win-win scenario in that it is an industrial metal much more than gold is, or likely ever will be. Plus, it's also a precious metal, so it has two different ways that it can respond to the market. And the industrial uses are multiplying. It's not just solar. It's medical uses of silver and other new applications. Do you remember back about 10, 15 years ago, everybody was saying, oh, silver is dead because photography is dead. It's being replaced. All the film is being replaced by digital photography. Remember that? But instead of dying, silver went on to just multiply the number of industrial uses it has, all of which, chews up the silver supply. Unlike gold, silver doesn't sit around on the surface of the earth. There's very little of it stored in vaults. Most of it gets used up in industry. So I do think that's quite bullish for silver. It's still going to track gold, within bands, but I suspect that the gold-silver ratio will reverse itself over the years to come.
I know about a year ago, platinum and palladium were the darlings of the precious metal world. How are they doing now?
Well, if you look at mining.com, whenever they talk about either, they show a photograph of a car smashing into a wall. Maybe that's not funny for those of us who bought into the platinum and palladium story, but we always presented that as sort of a hedge on our precious metals heavy portfolio, because those are even more than silver, very much industrial metals. They're used particularly in the automotive industry. There are a couple of interesting things about that, though. If precious metals are under pressure because the economy is recovering and we don't need those stinking safe haven assets anymore, then you would think that platinum and palladium would be skyrocketing because the economy is doing so well. But that's not what we see. We see trouble in Europe, trouble in China, less demand for these metals. This kind of puts lie to the other side of the equation. But again, we look at the palladium and platinum as sort of a pair trade to our gold and silver. If the one goes up, the other should go down. The fact that the platinum and palladium is going down is actually sort of encouraging about the more monetary of the precious metals.
We'll have more with Louis James next on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back to This Week in Money. We're speaking to Casey Research Senior Investment Strategist Louis James. Louis, where are you talking to us from right now?
I'm actually in Minsk, Belarus.
And so what kind of a feeling do they have in Eastern Europe right now about the economy, the markets?
Well, not all of Eastern Europe is the same, but there is still very much a sense of crisis over here. This particular country, they're planning to lock 3 zeros off the currency in January. which nobody ever likes, even if it, simplifies life. In some ways, everybody knows what it really means. It wreaks havoc with the economy as people put off decision making and investment until after the change and so forth. In the former Soviet republics, there's obviously a deep impact from the trouble with Russia and everything that's happened since the Ukraine conflict boiled up. So all of this has a strong impact here. But of course, crisis breeds opportunity. There are real bargain investment opportunities for anybody with the courage and the interest. There's commercial real estate here available that makes money now, but people are just selling stuff because they need capital. Not that there's anything wrong with the assets; they need cash. So it's an opportunity for the brave, but there are opportunities around.
Why is it people only concentrate on the negative aspects of a falling market and don't point out how you do that you could make some real good buys?
It is an issue of human psychology, and maybe the best way to summarize it briefly is to quote Rick Rule. And he points out that investors, rather than being rational man or economic rational activists, they're very emotional, and they make their investment decisions based on recent experience, not objective analysis, not value analysis. But I made money recently. Oh, I'm happy. I'm going to buy more. Or I lost money recently. Oh, I'm sad. I'm going to sell everything. And that's just the way the masses invest.
It's the same way as people are in casinos, I think. If they make an early big win, they decide, I'm lucky today, I'm going to keep on playing instead of doing the smart thing, which is walk away with that big wad of cash.
That is mathematically precisely correct. If we're talking about throwing dice, the odds of success of any throw is completely separate from the odds of the previous throw. They're all independent variables.
So you're throwing the dice right now. Where do you think people should be putting their bets?
Well, I'll have to switch my quotes here and quote Doug Casey, because we really don't think of ourselves as gamblers. We are rational speculators, and when assets that have actual value and use in the real world are oversold, you're not just throwing dice or throwing darts at a board. If something has real value and it's oversold, it's undervalued, eventually the market will go your way. Now, of course, being too early is the same as being wrong in most cases. And timing is everything. That's not timing the bottom, but timing the shift and the trend in general. That's obviously very important. And frankly, the correction in resources has gone on longer than we thought. That said, it does seem bottom-y to me, even if I don't know where the exact bottom is, and I see value deeply oversold, and to me, that's a buy signal. So that's what we're doing.
What's happening with crude oil?
Well, it's interesting because commodities tend to cycle together, and oil is one of them. And people look at gold-oil ratios as well as silver-gold ratios and other ratios. But gold has one set of dynamics, and it does have its monetary aspects, and oil has another. And right now, I have to say, it's looking like the glut is not going away. There are companies that have no choice but to keep producing, or they are in serious harm. There are countries that have no choice but to keep producing. OPEC seems completely unable to put the brakes on anything. The U.S. producers seem unwilling to put the brakes on anything. We've got a real glut shaping up. You've got Iran coming back online. And it's not just Iran. Iraq, despite ISIS and all this, Iraq's production from the war era is now coming back online and going up again. So, we like the right kind of energy plays. We like oil companies that make money regardless of the price of oil, the midstream companies and so on. But right now, in terms of exploration and production, it's really scary out there because it doesn't look like the glut's going away anytime soon.
China predicts it's going to have 6.5% growth each year for the next 5 years. Can we believe numbers like that?
Does anybody believe anything China says? Even if they produce the numbers, do you believe that's what it really is on the ground in an officially run economy like that? I don't know. I'm skeptical. There are there's a lot of mismanagement there still to be liquidated, malinvestment that hasn't come home yet. On the other hand, there are a lot of smart, hardworking people there. They have a lot of domestic capital now that is quite happy to be deployed. So I wouldn't count them out. I would say that we probably will see a lot more volatility than 6.5% every year for 5 years to come. It may go down more, but it may come back stronger.
Is the U.S. Fed definitely going to raise interest rates in December?
I don't think there's a definite anything, and I do think they are paying attention to global events, so it's possible that they won't. But I think right now, as strongly as they've signaled that they will, there would be a lot of egg on their faces if they don't, and that might matter to them. But that said, if they do, I think it'll be largely symbolic. It might be 0.25%, just so that they can say that they did, just to give them some small bit that they can pull back if they decide they need more stimulus. I think materially there won't be that much change, but my hunch is that they actually will do it this time, and there will be a nominal increase next month.
How much longer is the U.S. dollar going to continue to rise?
That in Wall Street, how long can a record bull run? It certainly seems like it's time for the tide to turn, and any number of causes could do that. I don't want to try to call a precise top, but again, in the same way I see oversold assets being good buys, good values, I see overbought assets as being something to avoid, and if not, go out and out short on it. And again, the problem with shorting is that you don't have to be just right in the direction. You also have to be right in the time frame when you take out a short position on something. But I certainly wouldn't want to be going massively long, general equities right now, and I'd be looking to ways to diversify out of the dollar.
Someone suggested the U.S. dollar has run its course as the senior currency for the world. Could the yuan replace it?
I don't know if it's the yuan or if it's the Russo yuan or if it's actually gold-backed rubles in yuan or whatever. But there's certainly a concerted and visible effort afoot to replace the dollar. And, this new system that gives countries an alternative to the U.S.-based and backed SWIFT system is very important. This is a true watershed change in international finance. So in my mind, this is not an if question. It's absolutely a when question. But these are not simple things. You don't change the de facto reserve currency of the world in a day, a week, or even a year. I think we're just going to see a continuing trend where more and more business globally shifts away from the dollar. It's not necessary to be in dollars anymore. Things won't be priced only in dollars anymore. Not gold, not oil, nothing really will be priced exclusively in dollars. We'll see a diversity rather than, I think, a sudden change from one to the other. We'll just see more options and more options over time with a dwindling role for the dollar.
Well, with a 75-cent Canadian dollar, for us, it can't happen too soon.
Yeah, though, actually, the bright side for that is for the Canadian producers paying their costs in Canadian dollars but selling commodities like gold in U.S. dollars. That's a big windfall, and it's helping a number of them survive that they wouldn't otherwise if the Canadian dollar were on parity with the U.S. dollar still.
Is it possible to deliberately devalue the U.S. dollar?
Yeah, anything's possible. Doug Casey's famous for saying that the U.S. should default on the national debt. So don't count anything out. We live in interesting times.
Louis, how can people learn more or get the Casey Research Letter?
We have a free publication called the Casey Daily Dispatch. There are links to that. If anybody just goes to caseyresearch.com, that's C-A-S-E-Y research.com. And from there are links to various publications like the International Speculator, which was Doug Casey's original newsletter 35 years ago, or is it 36 now? The one I now edit. Lots of different opportunities there, and we have people standing by if anybody has any questions.
Thanks a lot for chatting with us.
Sure thing, Jim. Thank you.
My guest has been Louis James, Senior Investment Strategist at Casey Research. That wraps up our show for this week. Thanks to our guests, Bob Hoye and Louis James, and thank you for listening. Comments or questions for the show can be emailed to info@howestreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.